how the bank finance the working capital finance. Then we talk about motives of holding cash. Then we talk about how the inventory is important and how the levels of inventory that makes an effect over working capital. Now, when we talk about inventory, when we talk about working capital, when we talk about cash management, we are always dealing with different types or levels of working capital. Now we're discussing about legalities of working capital. So when we are talking about working capital, we always are dealing in a confusion or in an era where we need to manage the different levels and different understandings how the role of finance change, how the conditions of financing are changing. So till date, have you revised and understood the working capital? If any doubt, you can just put it in this session, because after this session, we are not going to discuss about working capital. If doubt about numericals, because numerical are not there on working capital, we are not going to solve any numerical in working capital. For other chapters, we already discussed numerical in Excel. So it is suggested that whatever the issues about numericals that you people should discuss and put in chat box. If doubt, you can also post it via mail, or you can walk in a college and we can discuss. So to begin regulations, we discuss the regulations first created by internal. The internal regulations, they talk about company's policy and approach toward the working capital. Now these regulations are depend on type of company, how the companies are managing. Whereas there are some externals which we need to understand and allow for more concerns for any other sharings. Now let's talk about the most important, how this management is agile in 2025. So just to revise, working capital is important for operational continuity, stability, stakeholder confidence, and strategic balance, because it will give and boost and it will give and help that we need to manage this capital, because it is very essential for my business, very essential for taking strategic decisions and maintain the liquidity, because it will create a confidence and boost in the minds of investors, stakeholders, workers, and also give a smoothness in operational cycle for everybody. Now, what is cash conversion cycle? Where the working capital plays an important role. Working capital has a variety of role to play. If you are able to see, Working capital starts from the first cycle that I brought the inventory. Then working capital works when I do the processing of inventory and arranging the source of raw material. After arrangements of raw material and processing, the working capital has a role in selling the goods and dispatch. So overall, working capital has variety of role to play. So considering this, we can observe that working capital will work in every level and different role has to play. For example, it will play for receivables, it will play role in inventory management, it will play role in sales, it will play role in cash funds and so on. So the cyclic conversion is very vital for working capital. Now, what are the challenges? Now, in current era, the most important challenge about working capital is flow of money, managing our data, and limited bargaining powers. And today, we find there's a great complexity about data. The operational efficiencies are always making an issue about how to arrange funds because earlier the nature of working, the product cycle, the complexity of decision was less. Now, the use of data, application of AI has created a variety of needs. It has created a demand. It has created the product features which are more complex than the simple. The level of benefits, the nature of the products, and variation in price is very fluctuating because customer is a king and he is demanding. So accordingly, my production function, my operational efficiency need to manage. I'm also has to be very vigilant for my operational decisions and take a call regarding operational flow. So my production decisions are very complex. They need to be based on changing situations and market efficiency. I'm using modern tools like factoring, bill discounting, bill receivable, and so on. So in all cases, the volatility and cash management tools are changed. Earlier, I required funds. It can be my own funds or it can be borrowed funds. But now the limitation has started. I need to restructure my operational efficiencies. I need to understand complexity of managing. I need to analyze the financing from bank. I need to analyze the funds available from any other sources and see that these funds are allocated and managed properly. The nature of funds management is become a complex and very critical compared to the previous. Instead of only bank or self financing, now I have cheat funds, I have equity finance, I have debt finance, venture finance, I have short term loans, cash credit, overdrafts, overdrawn facilities, mini loans. So, considering all this, the options of finance are more. Whereas the fluctuations of rates because instruments in money market and capital market had changed. So it has created a complex and very high volatility in cash flow because it's a very competitive market. My competitors are always chasing me regarding the fluctuations. So what I was found that the bargaining power or the bargaining capacity is very limited because when I'm negotiating with the banks about my financial terms, then in that case, my competitor will take an advantage and he might influence about the bargaining power. So the banks, the other entities, they play a vital role, and I have a very limited choices when it comes to the bargaining power. So managing working capital is now become a complex decision, high risk profile, variety of options, and many demand sources I need to manage before I'm managing working capital. So what is current impact on financing of working capital? It has created a agile response because demands are very strongly changing and creating a strong influence over decision making. It has created a wide pressure on managing working capital. It has created impact that should be versatile in managing the funds, and the operational efficiencies or complexity has created a pressure that the demand for funds has to be reallocated as and when required. So the complexity nature has increased. When complexity increases, the skills which are required to manage are more. So when the skills required, I need to involve high skill people. In such case, the cost of operations and managing working capital is increased. The assets holding or borrowing has created tremendous pressure because I'm arranging funds. It can be internal or it can be external. So it is creating a pressure regards to manage the funds. So I have complexity, I have high skills. So it has influence over my borrowing capacity and rising the value of financing working capital. Now let's understand what are the strategies to optimize working capital. The first thing I need to do is regular monitoring the risk and assess the cash efficiency. I need to ensure that each department has departmental objectives, departmental SOPs. SOPs means standard operating practices, departmental inspection or audit cycles, and they are following the sequencing in proper way. Once quality norms are final, I need to have a continuous check and analysis about financial security and financial risk they are having. I need to verify the norms and standards to be observed, and I have to foster the habit of following rules and procedures in the minds of investors, stakeholders, and related individuals. Wherever the finance and liquidity issues or risk assessment I need to analyze. I need to negotiate with the this is second strategy that when I want to be a positive regarding working capital finance, I need to negotiate strongly with my debtors and creditors. I need to plan my expenditures in a such a way that considering industry alignments and current trends, I should negotiate about the terms of credit. I should negotiate about volume of business and make sure that all the contracts with the debtors and creditors are optimized in such a way that maximum credit period is available with the company and the cash conversion is positive. That means more credit period from creditors and less recovery period from debtors, whereas proper supply chain alignment, where I'm segmenting the customers, I'm segmenting the suppliers in such a way that based on need of material, the credit period is managed. When I'm purchasing in bulk, I will delay the credit period. When the price of product is high and it required very few, then for such creditors, I will have less credit period. When I'm buying bulk, I'll more go for the trade discount instead of cash discount and so on. So I need to formulate a strategy and negotiate so that my credit options can be varied and I can manage more. The leverage means the borrowing power or negotiations which I carried about borrowings. Leverage, I talk about a financial efficiency or operational efficiency which my firm can achieve, which my firm can enjoy. So earlier, humans or interface of humans or skills of humans are the only source to manage, to analyze the leverage value. Now, I can use the tools of AI to analyze and understand the leverage. I have option of using AI forecasting. I can analyze the other tools. So indirectly, the complex data ability can be one of the tools to use the AI. It will facilitate more better decisions, more quicker decisions, and give an intelligent solution for my managing risk about data, financing, and inventory integration. Mostly, the AI tools are very comfortable for managing complex issues about inventory management. They are always dealing about procurement, storage, and control over the flow of inventory, and it is always helpful for solving the issues about storage, issues about cost of ordering, issues about cost of dispatch, and so on. Similarly, AI will also help me regarding managing my funds in optimum way because my forecast to deliver process will reduce holding period of inventory and financing for the same. So, in leverage technology of forecast to deliver, I need to manage procurement and delivery of goods in a smarter way, holding the goods very rationally in lower duration. Minimum duration, if the goods are hold, it means the blocking of working capital will be less and it will enhance more cash generation. Similarly, for this, if optimize the flow of capital, it will greatly help for managing my resources. The fourth strategy which I can use is automation of recovery and invoices. I can take the help of AI tools. I can take the help of online tools, for example, factoring, cash cycle management, which is automated, and I can send the reminders in advance to the traders and creators about the payment cycles. I can issue the notes for proper holding. Like when we get the loans, we get a message from bank that this is your date of EMI. Please give the balance or please pay the due. Similar way, the companies start issuing the reminder notes and they channelize the flow of data, communication, reminders, data management and automated payment or receive system by using AI. This reduces human interference and can be very predictively controlled and helpful for managing the resources that is most important, cash. So flow of funds can be AI driven by using of automation in collection, by using invoice delivery to the data. This will reduce an efforts of miscommunication, overrating, and lapse in observing the obligation about collection or payment. And this creates a sound impact or validity and application in the minds of customer that the person or the company is vigilant and very vigilant about decision making in finance. So the payment cycles are optimized and honored on regular basis. The fifth strategy is purchase to pay. Now, this strategy is little critical because the credit cycle is very less, but this create an impact in the minds of supplier, and they might generate more and more advantage because in credit we used to enjoy the latter payments, but when have more purchase to pay strategy, here we are doing regular compliance and predictive insights and having very less payment cycle. It creates a confidence and boost in some supply. We when reduce the date or number of credit, that means I pay more quicker to my supplier, then I'm asking for more discounts. Similar way, when optimizing purchase to pay for datas, what I will enhance that I will go with different approaches, methods, skills, and schemes so that the payment cycle from datas is reduced. I will more emphasis on cash payments rather than my credibility. So, as per this cycle, I need to motivate my customers and suppliers to have more cash conversions rather than creatability. The sixth strategy for financing working capital is exploring working capital finance solutions. I need to divide this strategy into two factors: one, internal, second, external. The first, you can see, I need to manage my assets available. I need to restructure, realign, and reframe the valuation, their holdings based on market optimization and utilize these assets for my payments. I can also do the cost effective management, which will give the cost optimization that if the internal operation cost is reduced, it will give me a boost for managing working capital. If the cost is reduced, extra funds are available, and these funds can be source or application for working capital. So these two, so that is asset financing and cost optimization, are considered to be internal source of financing working capital. Whereas in some cases, I need to also approach external individuals for partnership benefits, where I have to strengthen buyers and suppliers. I have to talk about different finances and ensure the financing partnerships where the finance is available on effective way, cheaper rates, and at my convenience when I require working capital. So if I finance before my requirement, this will help me to borrow as and when required. Instead of searching later when the need arises, I'm able to get my funds more effectively. Now let's talk about real world impact and industry insight. We divide this real world impact in three levels. One, a production, second, a service, and third, a mixture. In case of most of the production companies, we have find the better challenge is inventory. The most important challenge is labor, and most important challenge is handling the flow of cash. So for manufacturing, we require three sectors, three domains, that is inventory, cash, and debtors and creditors. When I talk about service industry, the focus on inventory is reduced. We need focus on more about receivable management, that is debtors and creditors, because in service industry, the credit period compared to the manufacturing is very optimized and it needs to be negotiated very hard. When it's production and service industry, a combination, then we find they struggle over all three domains, but the impact of receivable management is less, but they have complex nature that sometimes they have to stress on inventory, sometimes they have to stress on receivable management. So most of the time, if we summarize, we always deal with two things: cash encashment of my sale and inventory management. Because these two domains always lock my money and I have less control over their volatility and flow. So considering this, I'm always been in a question how to manage my funds and how to correlate with this. For every effective working capital, to overcome these issues, I need to have certain value propositions. The first is I need to be vigilant about my liquidity and working capital sources. I need to use and adopt technological advantage for faster decision making and competitive advantage. I need to use the technology for management of inventory, management of funds, and reaching to the customers and suppliers for effective communication, recovery, and delivery of confidence, and maximizing my credit period. I need to keep my team motivated for rapid improvements, adopting new strategies by maintaining high motivation by continuous training and ensure that they are driving the cash flow in more positive way towards organization. So technical upliftment, proper training, motivation, and interaction with the customers and daters by adopting new methodology of AI, big data, blockchain, and so other tools will enable more efficient working capital management, and that leads to proper optimization of working capital. So if I conclude what I say, it's strategic priority, technological integration, and teamwork will make more effective working capital management and help me to proper take an action and channelizing my financing decisions. This all will reduce the cost of borrowings, cost of handling, and cost of delivery, and indirectly, they will create an value propositions towards wealth maximization. So that's all about working capital, its strategies, its policies, and legalities. Anybody has any questions we can discuss? Otherwise, I'll wait for 2 minutes, read this slide, and then we start revision of first unit. I'll wait 2 minutes. Please read the slide. No doubts, I guess, because nobody's posted. So let's start with the revision part. Now we'll revise the all 4 units remaining, and after the revision, we will start discussion about question paper, and we'll finish our syllabus by this Friday. And after the Friday, there will be no session on advanced financial management. So let me share the PPT for whole second unit first, that is capital structure and value of firm. This is our second unit. We talk about different theories. We talk about what is meant by capital structure. We talk about practical insight, and we understand how the structure of capital is making impact over the business success, the business finance decisions, and flow of activities in business. So we have some core definitions what we learn in this unit. The first is capital structure is a mix of own funds and borrowed funds, that is debt and equity, and a finance option a firm has to use to maximize its growth and operational efficiency. So there is nothing called a fixed capital structure. There is nothing called a fixed solution. Every business has to adopt its solution or a strategy which is suitable for their product, their competition, and nature of operations. They have to ensure the combination of debt and equity or borrowed funds and own funds in such way that the cost of holding will be less and maximum profit is retained to create an value proposition for organization. Many times this decision of capital structure has to be changed depend on the role or the level or the stage the business operations are holding. For example, if you're going with the mergers, if you're going with the takeover, if you're going with the restructuring, or if you're planning for expansion, the structure of capital can be changed. When we need the financings, we may go for more retentions. When we want rapid development or develop the goodwill, we will go for more payment of dividends, or sometime we can take a call about bonus shares, right shares, or buyback, depend on value managements of firm. So we need to manage the working capital structure in optimum way by understanding need. Then we assume that the value of capital is strongly impacting the financing decisions and the overall risk which I'm carrying for my arrangement of working capital is influencing the firm's value and reflecting its on cash flow. So indirectly, the cost of capital is influenced by source of finance, retention of profits, and the risk propositions I am handling. So the leverage values associated, it can be combined leverage, financial leverage, or operating leverage. They has a relation towards flow of funds and Nature of capital which I'm holding. Please remember, here I'm not talking working capital, I'm talking about my overall capital. We have first theory of cost of capital, which is called as net income approach. As per net income approach, as the name suggests, the income available for the equity owners, or we can say the true owners, should be maximized. This is a traditional theory. It assumes all other factors are constant. The cost and the value of firm, these are the only two things which are changing and we are calculating. So as per this, we assume the cost of debt remain constant if the cost of equity is constant. So as per them, the law, decisions, market condition, taxes, everything will remain constant. Only the cost of debt and cost of equity, two factors are changing, and they will create an impact over the cost of capital. Proportionately, when we optimize a structure of capital, we need to analyze that a combination should always create a value for equity owners, and the structure should always emphasize on wealth generation. So this theory is more oriented towards value creations and flow of income. They want more profit to be retained in organization because it's a kind of classical theories. All factors are constant. This was their limitation because in financial markets, making an assumptions that factors are constant is not practical, and they are ignored the increasing financial risk and potential risk of excessive leverage, because only focusing on borrowing cost and holding cost will not make an optimum capital. So the net income approach fails. So I repeat again, as per net income approach, I should have capital structure where borrowing or own capital, I should take a call based on the maximum profit is retained in the organization. Maximum money is with the organization. Then the second theory, what we learn in this chapter is net operating income approach. Now, in the first, we just talk about profitability. In second, they talk about operational efficiency, what we achieved. As per this approach, the capital structure is important, but the more important that how the funds for financing capital needs are available with the help of operational efficiency. So in net operating income approach, income generated by your assets, income generated by your turnover, and low cost is more important. This theory was a basis for approach, which they give 1958, and advocates risk and return is more strategic equation to manage working capital. As per net operating income approach, the cost of operations are more impact on the capital. If my cost of operations are cost effective and required less funding, then my borrowings are less, my financings are less, and my capital structure can be optimum. They propose the value of firm remains completely independent of capital structure, but it is impacted due to the cost of operations. So this is a modern approach where borrowing cannot be controlled. The interest which are required to pay for loans I cannot control, but I need to take a control about how I'm managing my business and how effectively I'm managing my business. So first theory talks about income, and second theory, that is net operating income, it talks about the profitability and efficiency of operation. The third theory is a traditional position where the combinations are less, and they talk about benefits and cost of leverage. Here, in traditional approach, weighted average cost of capital is given more value. As per them, the combination of owned and borrowed should contribute to the fund's maximum utilization and should maximize the firm value. This advocate that lower debt borrowings initially are more welcome because the funds are required for cheaper level and tax advantage can be taken. When the firm progress further in positive way, we can negotiate on borrowing terms and manage the risk and rising cost significantly, and we can take a call about more profitability and more benefits. Then the most important proposition is Moodle and Miller. They have proposed this proposition in 1951. There are two propositions. Moodle and Miller theory is to be observed as one of the modern and appreciated value. As per them, value of a capital or its structure has a revolutionary value, and without taxes, the value of firm remains unaffected because the tax and the risk are the major important players to make an impact over capital. Whereas they given second proposition that cost of equity increases with the leverage and risk, then that will create impact on capital equilibrium. So indirectly, they are considering risk, leverage, and taxes. These three domains are responsible for capital propositions, and they advocate that if the debt provides valuable tax shield, it will increase the leverage, but it will protect the interest of long-term holdings. So, risk and impact on firm's value depend on tax and the financial position is studied by Moodle and Miller. Their first proposition is about taxation, that if I'm beneficial in tax, then do the borrowings so that the tax advantage can be utilized for value increase. But if the leverage is risky and less tax shield is available, then to achieve the equilibrium, I have to maintain the equation of own capital and borrowed capital. So there are two propositions. The first proposition only advocate about application and use of funds and getting a tax shield. And second proposition talks about overall cost of equilibrium by using leverage value, tax shield, and maintaining financial risk. So in short, MM approach confirms significant tax benefits should be highlighted over the trade-offs and bankruptcy and financial distress. So they advocate that tax shield should be used as an instrument to consider my structure of capital. If more liability arises due to borrowing capital, go for the own funds. If the more liability about own funds, then go for borrowed funds if the tax shield propositions are positive. Then we learn about trade-off theory. In trade-off theory, what we call up is we have to moderate the leverage and the value associated with it in such a way that in case the cost increases, we able to switch from internal source to the external source. In trade-off theory, we need to analyze the flow of funds and their cost of flow. We need to take a call about retention. So here in this theory, they advocate about retention or payoffs, considering the future needs and value associated. I need to observe the moderate risk and leverages in such a way that they will create an better value for myself. So, as per trade-off theory, the firms need to strategically take a decision about complexity of own funds and borrowed funds, understanding the need of financial distress and level of operations. So, as per this theory, I had to focus on buyback shares, right shares, or bonus shares based on my phase of development and the cost involved. This theory is empirical in nature but lack about time value of money. They only influence about need of funds and source of finance. Similarly, even though this theory is a modern, they ignore the part of government contribution and change in technology. The next theory which we learn in capital structure is signaling theory. Signaling theory, in short, it is impulses or signals or hints which are received from the market. This theory is based on information or flow of information. It talks about four stimulations. One is the control of funds, second, data, third, stakeholders, and fourth, market response. I need to study the stimulus and flow of control in all these domains. And based on this, I need to decide what can be my capital structure. The first thing they talk about debt. If the debt management, I need to analyze the data, that is cost of borrowings, cost of lead generations, cost of holding, and how the funds can be managed or utilized. When I talk about market, I talk about competitors, talk about sale, I talk about the discounts, I talk about customer preferences, and based on this, I need to predict about my future cash generation and take a call about my capital needs. Then for stakeholders, I need to understand the options available with them, their demands, their past experiences, their future expectations, and what is the role of competitors in managing my stakeholders, whether they are interested for bonus shares, right shares, more dividend, more retention. So I need to analyze my stakeholders properly. Most important, in overall signaling theory, my importance is given towards flow of information regarding my influencing parties, their understanding, their requirements, and response to stimulus my action. So, this way, in signaling theory, I need to channelize my flow of information which is making an impact over my capital policy. I need to analyze what data creators, equity owners, stakeholders, they are thinking about my organization and they are expecting about my organization. So expectations of all the related parties about the business, it can be internal or externals, making and strategic influence over capital value. If more dividends are expected, then the cost of capital will increase. If less cost of debt is available, then the borrowing will increase. If future needs are demanding expansion or backward forward integration, then the retention of profits will be more. And this signaling theory advocates that use of information is and greater evidence rather than only talking about leverage or amount of dividend. Because irrespective of amount of dividend and leverage, the firm should talk about market flow or market changes, and based on that, they should take a call whether to retain profit, give profit, whether it should have own funds or borrowed funds. We'll quickly finish one more slide after this and then we'll stop for the day. The first, we need to have analytical tools what are available for capital structure are first PBIT and EPS analysis. So this is profit before interest and tax and the funds or profits which are available for my shareholders. So in first analysis, I will calculate the number of shareholders and their profit per share they are getting. Higher the profit the per shareholder gets, they are more happy and they will be more interested to retain with the company. If over the years I'm not paying any dividends and no return is generated, then people normally not interested to hold my security. So whatever the propositions or values or the amount I pay for the shares, if I do not require returns, then it's okay. But if I require returns and company is not paying, I'm not going to associate with this company. So in PBIT and EPS analysis, the importance of earning per share is more important. Investors will be more delighted and happy if more and more amount is paid to them. So here the payout ratio to the equity owners or shareholders is more important. Then second is return on investment and return on equity analysis. Return on investment comprise return on the fund invested, which is combination of equity and others, whereas return on equity is only returns toward the true owners of the company. So the profitability, if generated, what is the amount? How much out of them it's paid to equity owners is analyzed. In ROI, I talk about the profitability or earnings which I have learned, whereas in ROE, I talk about earnings which are given to the equity owners. So indirectly, in return on investment and return on equity, if I compare, I can analyze the profit available and earning distributed to the equity owners. So here I'm actually calculating the benefits received and benefit delivered to my equity owners. If there is a marginal gap, that high gap is there between ROI and ROE, it indicates firm's strategy about future plans. But if both are equivalent, it indicates that firm is not progressive. So the gap between ROI and ROE will give the hints about firm's planning, and that will create a confidence in the minds of stakeholder and make an impact over capital structure. The next is leverage ratios. Leverage ratios, that is ratios of debt and equity. There are first debt to equity, debt to capital, debt to interest coverage ratio, and debt turnover ratio, creditors turnover ratio. These are certain leverage ratios which will calculate my financial efficiency. This will calculate my cost of handling and managements. So indirectly, these ratios are giving a hint whether I'm progressive, I'm optimizing, or my losses or growth is there. And based on answers of this ratio, I can take numbers as response towards capital management. If I'm progressive, high risk can be supported. If I'm not progressive and I'm at optimum, then market is stagnant and I cannot go with more borrowings. I should emphasize more retention of capital and more internal source. So leverage ratios are one of the tools which gives an signaling effect about whether I should go with the borrowings, controlling or coordinating based on the firm's value and the risk associated about the borrowings. So it's almost 7:05. So let's remind what we learned today. We started on the note what are the 2025 changes about working capital, and we have understood the key insights. Then we started our first chapter revision. We talk about structure and theories of capital, and I introduce you different analysis methods. Next session, we'll discuss about Unit 1 revision and Unit 2 revision. Then we'll talk about numericals illustration. So this will take tomorrow's session. Then we'll talk about next session, the unit number 5 and numeric illustration. Then we'll deal with the numeric unit number 3. And on Friday 4th, we will discuss about the paper structure of advanced financial management. So please go through the syllabus, understand what are the issues, and till 4th, you can ask me the doubts online. After 4th of October, you need to walk into the college and ask me the doubts. So thank you being part of this session, and we'll meet tomorrow on same time. Wish you a wonderful day ahead. Thank you all of you. And in the morning there was no light available, so I joined a little bit late. So sincere apology about same. We'll meet tomorrow on same time. Good day.